So with that, I'm going to introduce Jerrad Schendel, who's going to take us down the industrial road and also the multifamily. Please welcome Jerrad to the stage.
Very cool. Hey, look at that. It works. Okay. Excited to be here again. So we're going to roll into industrial and then roll right into multifamily. So don't be scared by this graph. It's scary. A lot of red. Vacancy up. Lease rates down. Absorption down. Price per square foot down. But there's a good story here, and I promise. So before we go to where we are, we got to go back to where we were, right? This beautiful stairway, maybe you want to call it, looks like an elevator, real clean, right? All the way down to 2.2% in 2022. Can't make that up. Believe me, I double-checked it. 2.2% in 2022. In 2022, in the industrial market up here was insane. Couldn't find anything. You had people trying to buy out people's leases. So much stuff available. And then this right here, you see this little blue line dipping down, and I'll stand over here so you guys can get a little bit better look at it. But this blue line right here, that's the introduction of cannabis into the market. So you start seeing red strip up, go there, and then they level out to about $1.09 a square foot. So as we said, vacancy rate did increase, 6.8% from 5.8 previous year. Jason already touched on the almost 88% sales decrease. Not terrible when you take out that one big sale. Lease ask rates only went down slightly when you consider the negative absorption. That's not a bad thing either. The 145,000 of new deliveries in 2024 decreased from 3.9 last year. So we had 3.9 million square feet come online last year. And keep that number in your head, 3.9, okay? It's going to come relevant a little bit later. So negative net absorption, 194, plus positive absorption of 2.7 million. So it means 2.7 million square feet was absorbed the previous year. How much did we build? Nobody's paying attention? 3.9. So 3.9, 2.7 was absorbed. We have about 1.5 under construction. That's going to go online in 2025 to 2026. So keep those numbers in mind. 1.5, they're going to be important when we get to multifamily, okay? 2.7, 1.5, seeing some nodding. All right, I feel better now. The big story of last year was the under 150,000 square foot. Those guys absolutely killed it, the mom and pops. They absorbed 310,000 square feet of industrial space. The mom and pops were all generally moving up from down the hill, tired of the air quality board, tired of regulations. Great thing for our community, bringing businesses in from out of the area. Although we do have to kind of give that with a little bit of caveat. Vacancies have increased so far in Q1 of 2025, but most of the tenants that we're talking to are not saying that it's because of lease rates. It's outside environmental factors. Jason talked about the election, labor costs, new regulations, inflation, a lot of those different things as to why people are not renewing or decreasing the size of their space. Here's another number I want you guys to pay particularly close attention to. 31 million square feet going through entitlement or development right now. That's a huge number. We saw what 3.9 did, right? If we get 31 million, it's going to change the game in this market for a long, long time. And keep that number in mind as well when we start talking about apartments, because that number is going to come in huge. So even if it's half that number, we're not going to have enough housing stock in apartments to facilitate all of that, the people that are coming up here. So before we jump into apartments, though, I want to go over a couple of notable transactions with you. This is a Three Flags Avenue out in Hesperia, $6.5 million, $421 a square foot. Did include the business, though. Eucalyptus. This one is very unique property. A colleague of ours sold this thing. It is a unique owner-user building, really like nothing else. It was a distressed sell. The seller needed to get rid of it. And man, did he find the right fit for the right glove, for the right hand, finding this user, closing on it, at $146 a square foot. And then we have this concrete tilt-up in Apple Valley. Beautiful building. This one did not make it to the open market. Sold for $99 per square foot, $2.1 million. The guy that sold that developed it and ended up selling it to a tenant. Had it gone on the market, it would have sold for anywhere between $110 to $125 a square foot, depending on the conditions of the interior. Anacapa in Victorville. So you're familiar with this area. There is no buildings this size with yard space in that area. Very limited. So this one sold for $147 a square foot, which far exceeded any of the comps in the area. But how close are you to the freeway? Freeway access matters. especially here. As you can see, all the Coke trucks, we know what that might be. So we're going to move on to multifamily. So basically this graph right here with all the craziness, that's COVID, right? COVID craziness, moving in, moving out, can't evict people, specials, inflation, all that kind of stuff. So we're finally leveling out. This graph right here, I absolutely love, and I pay attention to this one pretty much more than anything else. As an investor, as an apartment owner, you're always wondering what your return is, what kind of properties are in the market. Your 4 to 5%, that's your value add stuff. That's the stuff where someone's paying $800 a month for a 2-bedroom when they should be paying $1,500, or the roof's caving in, one of those types of buildings, or on fire, one of those. 5 or 6%, that's going to be your clean properties in nice areas that someone's buying for a long-term buy and hold. 6 and 7, that's where the market's at. So we're about 40% last year, properties that sold in that market. This year upcoming, this will be over 50%. That's where the market's at right now, in between 6 or 7. That's generally where you're going to be at. This number, 7 and 8%, was unheard of the last 3 years. The fact that we're at almost 14% in 7-8 cap rates, now those are traditionally smaller units in, we'll call it less than desirable locations. But the fact that you can get a 7 to 8% cap rate now is insane. 2 years ago, even the stuff that was selling in less desirable areas was not going for that. This is a demographic representation of every unit that's sold this year. As you can tell, a lot of 1-bedrooms. That'll come up in a little bit in Victorville as to one age-restricted community, sold for a lot of money, and changed that all there. Normally, we're going to be 40, 50% 2-bedrooms. That's what our market is. All built in the 80s, all 2-bedrooms. Comparison between this year and last year, price per square foot, everybody's up but Victorville, but we've already talked about Victorville. They sold a huge building, all 1-bedrooms, sold for less per unit, but it held on price per square foot. So Adelanto increased 105 to 165, 155 to 180. We got to touch on Barstow a little bit. So Barstow is an anomaly. That 82,000 last year, we just happened to sell a building that was half burnt down. So obviously, price per unit was a little bit low last year. If you took that building out last year, you'd be about 102. Okay, 102 bucks. That's not bad. 102,000 a unit. So it did increase. The other thing about Barstow that I want to pay attention to is this price per square foot. So the fact that Barstow was able to hold 110,000 a door is impressive because they sold 2 larger buildings that were 1-bedroom with studios. So the fact that you were able to get that when they sold below that, and they're pretty significant for that market's not a huge market, so when you sell 2 buildings in that market with that size, it'll change the numbers on you kind of drastically. And so we are always talking about optimism in the market. What do investors think? So this was my COVID numbers. I did this one in 23. This is the same graph because I like to recycle. And I don't like to kind of go through and find new stuff, so we use this. So as you can see, during COVID, beginning of COVID, nobody wanted to sell. Towards the end of COVID, and maybe, right? Same thing. But the thing that I want you to pay close attention to is that there's always more buyers than there are sellers. So what does this year look like? Same thing, right? 30% want to sell. There's still 50% buyers. So it is still a seller's market. Although buyers are being more aggressive and underwriting more aggressively, it's still migrant. And then you got the guys in the middle that want to sell 1031 and change in to something else, bigger properties, primarily in your larger property owners tend to generally do that. So where do we go? What do we do? What were the numbers I said before? I already forgot. Anybody? 1.5, 31 million. Right, so we have 1.5 million square feet of industrial coming. In 25, 26, it's already under construction, already being built. We have another 31 million in entitlements. Where are those people going to live? They got to rent apartments. They got to live in housing, right? We do not have enough right now being built under entitlements for the population growth that we are going to have. So what happens? Supply and demand. Vacancy rates are going to decrease, right? And you're going to continue to get increased rent growth. So buy and hold. Populations will continue to outcrease supply. You're going to be in a pretty good market 5 to 10 years from now. If you're buying and holding for the long run, that's where those 5 to 6 cap rate properties come in. And the market has finally adjusted. So what you're seeing now with the high vacancy rates, and by high I mean 6%, that's nothing. When I first started, we were selling stuff with 15 to 20% vacancy rates. So this is nothing compared relative to the market. And that COVID fever where you couldn't evict anybody, then you could, then you got rent assistance, then you didn't. has finally leveled off, and now we're just at a peak market. So although rent has only gone up 1.2% last year, it went up double digits for the last 3 years. So we're just leveling off, catching up. AB 1482, a lot of landlords haven't caught up yet. Those that don't know what 1482, statewide rent control, only 10% a year annual is the most that you can raise a property, rent from a property. So this is that property that I told you about. So as you can see, mostly one bedrooms, sold for $150,000 a unit. That brought Victorville's numbers down, but did help with the overall sales volume. You take this property out, our sales volume's down on multifamily. This is, I would call, your basic average Apple Valley apartment, sold for $187 a door, 4.5 cap rate. So again, what do we say about 4 to 5 cap rates? Value add, the rents were extremely low on this one. This is gonna be a long-term hold. There was some deferred maintenance that needed to be done as well. Victorville, I can't even explain this building. So this building had been on the market for like 3 years at the same price, in various states of conditions and units and everything else. That's a great picture of it. That's not the way that it looks if you drive by it. But they were still able to get $145 a door for this at a 6.1 cap rate. There was some value add play there on some rents and some cleanup and different things like that. But just the fact that they sold that building for a 6 cap rate kind of tells you where the market's at. Apple Valley, Desert Knolls, best area of Apple Valley, some people say. Some people, Doug in particular. But this is what I want you to pay attention to right here. 5.9 cap rate in Desert Knolls is unheard of, right? We're now in the 6 cap rates in Desert Knolls. That's been 5s forever. So we're seeing it trickle up. And this building had pristine condition, low rents. So there was a little bit suppression there. Right across the street, same owner, different buyer, but you see 6.1 cap. That's kind of where the market's heading. So we're leveling off. Those 6 to 7 cap rates is what you're going to see next year. And I'm going to turn this back over to Jason so he can finish this off so we can hurry up and get to Thornburg, because that's what I'm excited about.
Thank you, Jerrad.